The National Treasury has proposed new draft legislation that will significantly change how retirement savings are managed in South Africa, starting from March 1, 2024. The key feature of this legislation is the introduction of a two-pot retirement savings system. This system will split your retirement savings into two distinct pots, a savings pot and a retirement pot. Key points to note. 1. Access to the savings pot. Starting March 1, 2024, you may access up to 10% of your retirement savings, capped at 25,000 rands, in a new savings pot. However, you need at least 2,000 rands in the pot to make a withdrawal, meaning if your savings are under 20,000 rands, immediate access won't be possible. Remember, withdrawals will reduce the lump sum you can take at retirement. 2. Contributions and pots. The new system divides your contributions. 1/3 goes into a savings pot, accessible annually, and 2/3 into a retirement pot, locked until retirement. Pre-March 2024 savings, known as the vested pot, follow existing rules, typically restricting access until retirement or job termination. 3. Tax implications. Withdrawals before retirement are taxed at your marginal rate, up to 45%. However, if left until retirement, you can withdraw it alongside 1/3 of your vested savings, with the first 550,000 rands being tax-free, assuming you haven't used this allowance before. 4. Defined benefit funds. For defined benefit fund members, your savings will be split based on years of service. The vested pot will cover years of service up to March 2024, while future years will contribute 2/3 to the retirement pot and 1/3 to the savings pot. Withdrawing from the savings pot reduces your service years proportionally. 5. Opt-out for older Provident Fund members. Provident Fund members aged 57 and older can opt out of the two-pot system. If they remain in, 2/3 of future contributions must go to the retirement pot, with the rest going to the savings pot. Opting out forfeits immediate access to 10% of current benefits. 6. Exclusion of older RA funds. Older retirement annuity funds will be exempt from the two-pot system, meaning no access to savings in those RAs. These funds often have insurance components, bonuses, and penalties that make splitting savings difficult. 7. Withdrawal restrictions. Certain conditions may block withdrawals from your savings pot, such as having a home loan guaranteed by your retirement fund, owing your employer for damages, or undergoing a divorce where your ex-spouse doesn't consent to the withdrawal. Court-ordered maintenance payments may also restrict access. 8. Emigration rule. If you emigrate, you won't be able to withdraw money from the retirement pot for 3 years. This aligns with current rules for RA and preservation funds, limiting access for 3 years post-emigration. Final thoughts. Withdrawals reduce retirement income, so only withdraw if absolutely necessary. Experts advise using the savings pot as a last resort for true emergencies, like preventing home loss or covering urgent medical treatment. This legislation represents a major shift in how retirement savings are managed and could have significant implications for your financial future. Be sure to plan carefully and seek advice if you're unsure about the best course of action.